Welcome to this very first session of accounting in the Wisest King Academy. Today, we are going to be looking at a basic aspect of accounting, actually known as the financial statements of a sole trader. Who is a sole trader? A sole trader is a person who has contributed the capital of his business alone, who bears the risk of the business alone, who enjoys the profit of the business alone, and equally suffers the loss of the business alone. Such a business is not separated from the owner, and by so doing, the sole trader has an unlimited liability. What does that mean? It means if the business has a debt that it cannot pay, that debt actually extends right into the private properties of the owner of the business or the sole proprietor. Now, with such a business, the sole proprietor can remove money from the business at any time or remove goods from the business at any time for his own personal use. And such transactions are known as drawings. Likewise, he can take his personal money, settle the debt, or pay expenses of the business, or pump in the money into the business that will actually increase the capital of the business. So, the main objective of this lesson is to be able to prepare the financial statements of a sole trader. Now, what is the content of the financial statement of a sole trader? The financial statement of a sole trader is actually comprised of two things. It's actually comprised of the statement of financial position, which we call the balance sheet, and it also comprised of the income statement. The income statement. What they call the statement of trading and comprehensive income. Let me just cut it short here. The income statement. It's called the statement of trading and comprehensive income. So we will work in an inverse order because usually we prepare the income statement first, then the statement of financial position. So we are going to work first of all on the statement of financial position. Now, the statement of financial position is the name given to balance sheet. So you can say balance sheet or statement of financial position, it is still correct. But the most recent term used, statement of financial position. Now, what is a statement of financial position? This is a financial statement that sets out the financial position of a business after a particular period of time, usually 1 year. It sets out the financial position of a business after a particular period of time, usually 1 year. Now, the statement of financial position shows the assets, liabilities, and the capital of the business. So, we are going to elaborate on these three aspects. So, let's take the first one. Number one, assets. Now, what are assets? Assets are those things of value owned by a business. In other words, as we can say, assets are the properties of a business. Now, assets are divided into two broad categories. There's what we call non-current assets, non-current assets, and current assets. Now let's take the first one. Non-current assets. Non-current assets are also called fixed assets. So non-current assets are assets of permanent nature. That is, they are assets that have a long useful life. In brief, we say non-current assets or fixed assets, they are those assets that last for more than 1 year. So in accounting, we'll talk about the current and the non-current. The current is within 1 year, the non-current is more than 1 year. So non-current assets, they are assets that have as useful life greater than 1 year. These assets are subdivided into two categories. We have intangible non-current assets (NCA) and tangible (NCA). Now, intangible non-current assets, they are assets that cannot be seen or touched, but they are useful to the business. They are important to the business. Example of non-current asset, an intangible non-current asset, we have goodwill. Goodwill, we have trademarks, we have patent rights, etc. Now, those are some examples of intangible non-current assets. Whereas tangible non-current assets, we know they are assets of permanent nature, they last for more than 1 year in the business. These assets are classified in the statement of financial position from those with the highest or longest useful life to those with the shortest useful life. Example of that classification include land and buildings, plants and machinery, furniture, fixtures and fittings, equipment, and finally motor vehicles. So this is the classification of tangible non-current assets according in an decreasing order of their useful life. Okay, so we move to the second. We have current assets. Current assets, also called short-term assets, they are assets that actually last for less than 1 year or within 1 year. Generally, those are assets that are held with the purpose of resale. Number one, those are assets that comprise of cash and those that can be easily converted or that are easily convertible into cash. And now, current assets are classified in the statement of financial position in an increasing order of liquidity, starting from stock of goods, which we actually call inventory. Stock of goods, that's inventory. Trade debtors, which we also call account receivables. So when you hear of receivables, it means debtors. We also have cash at bank, which is summarized as bank. And we have cash in hand, which is simply cash. So this is the classification of current assets in the statement of financial position. So that is it about assets. Now, let's move straight to the second, liabilities. That's number two, liabilities. Liabilities. Now, what are liabilities? Liabilities are the debts of a business. They are actually the obligation that the business has towards third parties, towards people other than the owner of the business. Now, liabilities are classified into two categories. There's what we call non-current, non-current liabilities, and there's what we call current liabilities. Now, non-current liabilities are actually those debts of a business that are payable after 1 year. Our examples here will include bank loan. Here, bank loan that are payable after 1 year, because we equally have short-term bank loan that are payable within 1 year. Now, this is in the case of a sole trader. If we go straight to if we go to in the case of a company, there's also debenture loan. Debenture loan will actually fall under non-current liabilities. So let's go to current liabilities. Current liabilities comprise of those debts that are payable within 1 year. Example, we have trade creditors, also called accounts payables. Then we equally have um, bank overdraft. Bank overdraft is a situation where the business runs a current account and withdraws more than what it has in the account. Now, the excess amount is actually a short-term loan, which is actually charged a very very high rate of interest. So that is called bank overdraft. There are also short-term bank loans. So when we look at further topics like financial statements adjustments, we are going to see other things that will be added under current assets and current liabilities. But for now, when you pick up the books of a sole trader, the statement of financial position, this is actually what you are expected to see. Okay, that is that about liabilities. So let's go straight to capital. Capital. That's number three. Capital is actually the contribution made by the owner of the business. Contribution made by the owner of the business. Capital is actually what the business is owing the owner. So, in other words, capital is like a kind of liability, but under the name capital. Liability, debt that the business is owing third parties. Capital, debt that the business is owing the owner. Okay, now in the statement of financial position, capital is affected by two things, or let's say three, although one is comprised of two. The first one, capital is affected by net profit, and capital is equally affected by drawings. Now, when the business makes a profit, that is after preparing an income statement, if we have a net profit, the net profit is added to capital in the statement of financial position. But if the business makes a loss, opposite of profit is loss. So if profit is added, this loss will be subtracted. Now, drawings. Drawings are actually money or goods taken out of the business by the owner for personal use. They are called drawings. So they actually reduce their capital. So we are going to look at the format of a statement of financial position. Now, there are two formats. There's a horizontal format. The horizontal format. This format takes the form of a T account, and it actually reflects what we call an accounting equation. The accounting equation is generally called the balance sheet equation or the statement of financial position equation. Why? Because the horizontal format of the statement of financial position actually reflects this. Now, on the debit side, we have assets, that's a non-current asset and the current asset. Meanwhile, on the credit side, we have capital, which we know what is affected. We have net profit and drawings. We have non-current liability and we have current liabilities. Now, When we bring this together, the total should be the same. So this actually reflects the accounting equation, which states that what? Which states that asset equals to capital plus liability. Asset equals to capital plus liability. It is called a balance sheet equation because it is reflected by the horizontal format. Now, let's go to the vertical format. All of the questions we'll be solving in accounting will mostly use the vertical format. Now, with the vertical format, the vertical format brings out, in fact, it has two sections. It has the upper section and the lower section. And both sections shows the calculation of what we call capital employed. Capital employed is calculated in two ways. Capital employed. Let me write this here. Capital employed. Capital employed can be calculated, number one, either by taking non-current asset plus working capital, where working capital is the difference between current assets and current liability. Capital employed in the second section of the statement of financial position is called equity and liabilities. Now, then it is calculated by taking what? Capital plus non-current liabilities. Please, let us not forget, capital is affected by net profit and drawn. So this is actually reflected in the horizontal format. So if I should put this down here, now non-current assets, let's say we have Francium A. Non-current asset. Now we have current assets, I take it down, less current liability, I take it down. The difference is called working capital, which I take to the last section. Now, fixed non-current asset plus working capital give capital employed. I'll call it Y. Now, in the second section of the balance sheet, finance part, we have capital, we add net profit, we left drawings, and we have this total. Please, this total is known as the net worth. Capital plus net profit minus drawing is known as the net worth. Now to this, now we take non-current liability if any. We take current liability if any. Sorry. We have already charged current liability off. So we take non-current liability and when we add, it gives us what we call capital employed. Which is still the same Y. Balance sheet. So it has to balance. If it does not balance, it means you made an error somewhere. So this is the vertical format of a balance sheet. So we can see. Take 5 seconds to analyze. Okay, let me wipe the board. We are going to move straight to the second type of financial statement. The second type of financial statement that is called statement of trading. Statement of trading and comprehensive comprehensive income. That's really long. So I'm going to just call it the income statement. Now, the statement of financial position is usually prepared as at, but the income statement is usually prepared for a period ended. Now, the income statement shows the performance of the business. The income statement is a statement of financial position. Sorry, is financial statement. Sorry, that shows the gross profit and the net profit. The income statement is divided into two broad categories. Number one, the trading account, and number two, the profit and loss account. So, the statement of trading and comprehensive income or the income statement is also called trading and profit and loss account. So, let's look at the first one. Number one, the trading account. This is that part of the financial statement, that is, that part of the income statement that shows the calculation of the net profit. Sorry, it shows the calculation of the gross profit. It's that part of the income statement that shows the calculation of the gross profit. Now, the gross profit is the difference between sales and cost of sales. Generally, we say sales and cost of goods sold, but cost of goods sold is quite a long statement. So, cost of sales. In accounting, sales means goods sold. Now, the difference between sales and cost of goods sold. Now, what is cost of goods sold or cost of sales? Let me abbreviate. Cost of sales is the sum of what? The cost of goods available for sales minus the closing stock. Permit me to use this. So minus the closing stock. Now this is cost of goods available for sale. Why this is cost of sales? So cost of sales is the difference between cost of goods available for sale and closing stock. Whereas cost of goods available for sale is the sum of the opening stock as of 1st of January 2000 and purchases. The trading account shows the calculation of the gross profit. The gross profit is the difference between sales and cost of sales. What we sold, what is its cost? I cannot go to the market and buy 10 articles and I come back, maybe I bought the 10 articles for 10,000. So it actually means I bought one for 1,000. And I sell 8 of those articles for 1,500 francs. 8 of those articles for 1,500, that's going to give me 12,000. So I cannot take the sale of 8, I subtract from it the cost of 10. No. What I should subtract from the sale of 8 to give me my profit should be the cost of 8. So that's why we take sales minus cost of sales. Where cost of sales is cost of goods available for sale, the difference between cost of goods available for sale and closing stock. I always love using differentiating opening stock and closing stock using dates. It's very, very important because dates is an aspect in accounting that if you understand dates, then you find most questions easy, or you have a step ahead in most questions. So, cost of sales is cost of goods available for sales minus closing stock, whereas cost of goods available for sale is opening stock plus purchases. Now, there are other things we need to know. If there are returns inward, returns outwards. Returns inwards are also called sales returns. Returns outward, purchases returns. What we should note is that returns inwards are subtracted from sales to have net sales. Meanwhile, return outwards are subtracted from purchases to have net purchases. I repeat, if there are returns inwards are subtracted from sales, and while return outwards are subtracted from purchases. Now, these total are extracted from the returns inward and the returns outward journal or daybook. Now, if there are carriage in accounting means transportation cost. Carriage inwards, carriage outwards. Carriage inwards are actually transportation costs spent transporting goods bulk from the supplier's warehouse to the company's warehouse. Whereas carriage outwards are transportation costs spent transporting goods sold from the company's warehouse to the customer's warehouse. So, carriage inwards, also called carriage on purchases, actually increases the purchase cost. So if we have carriage inwards, it is added in the trading account. Meanwhile, carriage outward is added or is charged as an expense in the profit and loss section of the income statement. And okay, there we have. That is the trading account. Now we go straight to the profit and loss account. Or let me write this down. Gross profit equals to, if I open a bracket, let me write sales minus cost minus returns inward. Now minus, I open a big bracket. Now I will take opening stock, that is stock as at 1st of January 2000XX plus, I open a big bracket, I'll have purchases. From purchases, I'll subtract my returns outwards. Right? I'll subtract my return outwards. Then I'll add carriage inwards. Now, from these two, I'm going to subtract the closing stock. That is stock as of 31st of 12, 2000XX. So that is the calculation of the gross profit. This is called net sales. This is called cost of goods available for sales minus closing stock. That gives cost of sales. Whereas all of this now, cost of goods sold or cost of sales. So that is the trading account section of the income statement. Please take 2 seconds to glance through. Okay, we are going to go straight to the profit and loss section. Then we get the format. This one will be a bit long. With this, I'm going to solve just a single example. But I'm going to drop the link of a series of about 4 or 5 questions under this topic. You can download it, attempt the question. I'll equally drop the Telegram link so that if you solve the question, you can submit it in the group directly and I will respond. Okay, now the second is the profit and loss account. The profit and loss account is that section of the income statement that determines the net profit. Net profit. Net profit is actually the difference between the gross profit and trading expenses. Trading expenses. Now, note, let me first of all start. What are trading expenses? Or what are expenses in general? Expenses are the charges incurred for the smooth functioning of a business. Charges incurred for the smooth functioning of the business. For example, we have wages and salaries, rent and rates, carriage awards, discounts allowed, advertising, postage and stationery, insurance, commission, general expenses, maintenance, etc., etc., etc. Lighting and heating. So those are examples of trading expenses. Rent and rates, those are examples of trading expenses. Now, before we subtract our trading expense from the gross profit to have the net profit, we need to verify, are there other incomes? If there are other incomes, for example, rent receipt, discount receipt, commission receipt, right? These incomes are added to the gross profit before the expenses are subtracted. I repeat, if there are other incomes, these incomes are added to the gross profit before the trading expenses are subtracted. Now, when we take the difference, we have actually our net profit. So, we are going to look at the format now of an income statement, and precisely we'll look at the vertical format. The vertical format. Okay, we have income statement for the year ended 31st December 2000 XX. I always like using three columns, and here we report in France CFA. So we start with our sales. From our sales, we less returns in what that is also called sales returns. When we subtract it, we have our net sales here. Now from it, now we need to less cost of sales. So the first thing we have there is stock as of 1st of January 2000 XX. We take it to the middle column. We have our purchases. Now, if we have returns in or outwards, we are going to take our purchase in the second column. But if there is no returns outwards, we take it directly to the second column. We are going to take it to the first column. But if there is no returns in outwards, we take it directly to the second column. Now, from this, now we less returns outward. That's also called purchases returns. We bring our net profit, our net purchases. Now, we have carriage inwards. We add carriage inwards. Now, the sum of these three is called cost of goods available for sale. From it, now we less closing stock. That's stock as at 31st of 12, 2000 XX. When we subtract that, what we have now is our cost of sales, which when we subtract from our net sales, it gives us our gross profit. Or we can even have a gross loss. So we can have a gross profit or gross loss. Now, if we have other incomes, let's say for example, we need to add them. Rent received, rent received, commission received, discount received. Any of them will bring the total. This total is actually called total gross income. From the total gross income, total gross income. From the total gross income, now we can subtract our expenses. Less expense. Expenses, we have stuff like discounts allowed, wages and salaries, rents and rates, carriage outwards, advertising, lighting and heating, insurance, postage and stationery. Those are other examples of expenses. So take this in the middle column. When we add, we break the total, which when we subtract from our gross profit, we are going to have a net profit or a net loss. So that is the format of an income statement. This is the format of an income statement. So we have a net profit. Remember, this net profit is added to capital in the statement of financial position. We have a net loss, it is subtracted. Now, I'm going to give you some few tips. The income statement and the statement of financial position, they are prepared from the trial balance. So when you pick up the trial balance, there are things you should see. When you see them, you should know what it means. Now, I take example. You might see returns, and it's on the debit and actually on the credit. Returns on the debit is returns in what? Meanwhile, return on the credit is returns outwards. You might pick up the trial balance and you find discounts. Discount on the debit is discount allowed. Discount on the credit is discount received. So this is an expense and this is an income. Purchases, sales. Purchases is debited, sales is credited. So if you find rent on the debit side, it's rent expense. If you find rent on the credit side, it's rent income. So I bring us to some basic things in the double entry. All incomes are credited and all expenses are debited. We should note that. All assets are debited, all liabilities are credited. Capital liability, they are credited. Expenses, assets are debited. Incomes are credited. So, there are things when you see in the financial statement, the position matters. If you see, for example, bank, and you see the amount on the credit side, it means bank overdraft. If you see it on the debit side, it means it's an asset. That's cash at bank. So those are some of the things we need to know when we are preparing a financial statement. So now we are going to pick up a question and solve and see whether a statement of financial position is going to balance. Let's rewind the board. So, this is the question. The link to this question will be placed in the description section of this video. Likewise, the Telegram group, the link of the Telegram group, please subscribe to this channel. Share to those whom you know, it will help. Please comment, and you can attempt the question and send your solution to the Telegram group. I will gladly evaluate, I will gladly go through. Okay, the first question. From the following trial balance of Chi James, draw up a statement of comprehensive income for the year ended 30th September 2019 and a statement of financial position as at that date. Here we have purchases and sales. We have stock as at 1st of October 2018, carriage outwards, carriage inwards, returns, that's returns inward and outwards, salaries and wages, warehouse rent, insurance, motor expenses, office expenses, lighting and heating expenses, general expenses, premises. Premises is another name for land and building. Premises, motor vehicles, fixtures and fittings, debtors and creditors, cash at bank, drawings, capital. So from this, we are to prepare the income statement and the statement of financial position. So let's take Chi James. Income statement for the year ended 30th09/2019. This should be the closing date. That's why opening stock, if you look in the trial balance, is 1st of October 2018. So we are going to have something like this. The figures are in 000 francs CFA. Now we start with sales. Do we have returns inwards? Yes. Our sales is 380,400. So we less returns inwards. Our returns inwards is 1,540. 1,540. Let me get the calculator. 380,400 minus 1,540. That's 378,860. 378,860. So that is our net sales. So we go straight to less cost of sales. So we start stock as at 1st of October 2018. We take it to the middle column. The opening stock value is 41,600. 41,600. Now we add our purchases. The question we ask is there returns outwards? Yes. So put our purchase in the first column. Purchase is 188,430. So we less returns outwards. Our returns outwards is 3,410. When we subtract, let's calculate. 188,430 minus 3,410. 185,020. 185,020. Now we add carriage inward. A carriage inward is 3,700. When we add, this is actually called cost of goods available for sales. So we did 41,600 plus 185,020 plus 3,700. 230,320. 200, 230,320. From this, we let the person stop. Stop as at 30/09 2019. Please note the closing stock is never given in the trial balance. The closing stock is always given as note as additional information. There are some notes, some points to note when preparing. And now we can see this under our trial balance here. We have stock as at 30th September. That was 44,780,000. Don't forget, we have summarized three zeros up. So we are going to remove the three zeros down. We are going to have 44,780, which we are going to subtract. When we subtract that, the difference is going to give us our cost of sales. So say minus 44,780. So that's going to give our cost of sale 185,540. Which one we subtract? What is our cost profit? So say 378,860 minus this our answer. It gives 193,320. So that is our gross profit. Now the question we also ask, are there any other incomes or is there any other income that should be added? Remember, all incomes in the trial balance are credited. I don't see any. I don't. Whereas in other questions like example 3, that's question 3, you'll find a sundry income there which we need to add here before subtracting the expenses. Likewise, example 4. But in example 1, we don't have any. So, since we don't have any, we go straight to subtract our expenses, less expenses. I will recommend when you are answering questions in the income statement and the statement of financial position from a trial balance, please start with the first expense going down. Do not select haphazardly. You might leave out some expenses that you might forget and not use in your income statement. So what you start with, actually start with the first expense. And now here, our first expense is carriage output. Carriage out. Carriage output is 2,100. After carriage output, we have salaries and wages. Salaries and wages. Salaries and wages, that is 61,400. After salaries and wages, we have warehouse rent. Warehouse rent is 3,700. After warehouse rent, we have insurance. After insurance, we have motor expenses. After motor expenses, we have office expenses. After office expenses, we have light and heat expenses. After light and heat expenses, we have general expenses. I believe that should be the last. Yes. Okay. Insurance, warehouse rent, insurance, 1,356. 1,356. 1,356. 910, 412, 894, and 245. So let's add to have the total expenses 2,100 plus 61,400 plus 3,700 plus 1,356 plus 1,910 plus 412 plus 894 plus 245 equals to, that's 72,017. 72,017, which when we subtract, we have our net profit of, so take 193,320 minus that answer gives us 121,303. So our net profit is 121,303. So that is our net profit. This section of the board is small, but permit me, I will squeeze my statement of financial position in that angle. So please, 5 seconds, just take a look. Take a look. So, G. James, statement of financial position as at 30th September 2019. My statement of financial position, I'll equally have three columns. 000 plus CFA, 000 plus CFA. I start with my non-current assets. Now, in our trial balance, how many non-current assets do we have? I can see premises, I can see motor vehicles, I can see fixtures and fittings. So we have three non-current assets. So we'll start with premises. After premises, we have fixtures. Fixtures and fittings. After fixtures and fittings, we have motor vehicles. So this is what I'm going to do. I'm going to record this amount in the first column. Premises is 92,000. Fixtures and fittings 1,900. Motor vehicles 13,400. So nothing. These same figures I'll bring in the last column 92,000. 1,900. 13,400. So the total of this we have 0, 0, 3. This is 6, 7, and 10. 10,000. 107,300. 107,300. So that's the total of our non-current assets. So we go straight to current assets. Now we have stock, and the stock that is used here is the closing stock. Stock as at 30th of 09/2019. The closing stock, which is actually 44,780. 44,780. We take debtors. Debtors also called accounts or trade receivables. Debtors is 42,560. 42,560. After debtors, do we have cash at bank? Oh yes, we have cash at bank. which is cash at bank, 5,106. 5,106. Do you have cash in hand? No. So we add this. I will put my total down. But you can still put your current assets in the first column and take your total in the second column. It's the same thing. So let me look at the total. 44,780 plus 42,560 plus 5,106 equals to, that's 92,446. 92,446. Now we less our current liabilities. Now we have just one current liability here, which is what? Creditors. Our creditor is 31,600. Now, if we have many, we'll put in the first column, then take the total in the second column. So you could bring it here once, or you do like this, it's still the same. So the difference between current assets and current liability is called working capital, which I'll take to my last column. So if I take 92,446 minus 31,600, that's going to give me 60,846, which when I add, it gives what I call capital employed. Now capital employed will be plus 107,300. 168,146. 168,146. So that is our capital employed. That's the first part of the statement of financial position. Now let's go to the second part. Financed by capital. What is our capital? Our capital is 68,843. 68,843. Our net profit. Our net profit. Our net profit is 121,303. Now less drawings. Our drawings is 22,000 francs. Now we take the total one. So 68,843 plus 121,303 plus 22,000. That's going to give us, sorry, I added instead of subtracting. 68,843 plus 121,303 minus 22,000. 168,146. So that will be 168,146. Is it balanced? Yes, it is balanced. So this is also called capital employed. So these are the financial statements of a sole trade. So you can see from the trial balance, we have prepared the income statement and the statement of financial position that is actually balanced. This one, they don't have any, there's no non-current liability, there's no debt. That is why our net worth is equal to our capital employed. So this was example number 1. You can find example 2, example 3, and example 4. The link will be dropped in the question. The link will be dropped in the question. So please download it, attempt it, why not? And please put your comments down there. I need your comments. Subscribe to the channel. Please share this link for others to join the channel. Thank you very much. It was my pleasure serving you. Till next time,